later, but things I had to adjust maybe.
The goal that you're trying to get
Yeah.
with your, and that's for me.
Location fits into it. So the long and the short of it is.
Absolutely. How about at the end of the day? Do you do anything? Like, I'm really fascinated by rituals and things like that.
So I think it's really important to be ethical and actually paying them well above.
What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Hello, good afternoon, good evening, good morning, g'day, wherever you're joining us from. My name is Owen Rask, and thank you for holding on the line. I can see Emily's already said good afternoon. Are we on today? Emily, we are, and I apologize for the delay. I was just scrambling to find something for a presentation, and I fortunately couldn't find it. So maybe this Thursday I'll bring it up. But if you can hear me loud and clear, please let me know. That'd be great. We do have a lot of things to get through today, and it's a delayed session for folks that saw last week. I actually have laryngitis, so I'm going to try and push through today. I'm going to try and speak calmly and not use too much of my voice. And I've got my water here. So g'day, Connor, Financial Freedom. So I'm going to try and get through it, and we'll see how we go. But this Thursday, we are running the next session, which is on investing in ETFs. So today is all about the share market, generally speaking. So I've got heaps of things to bring today, whether it's for Australian shares, US shares, Jamaican shares, whatever is going on in your neck of the woods, you can take some of these principles with you. But obviously, we're going to talk about some things which are Australian centric, like franking credits and these types of things. So I'm just going to get out of some of these things I've got here in front of me. Jim, you've said chucking a sickie again. Nothing wrong with that. We've all been there. Yeah, it's Jim. I've got so much that I want to get through before the end of the year, and so does the team. That there's no rest for the wicked. But I got to admit, like, last week's laryngitis, if it wasn't for the fact that I couldn't talk, I would have pushed through. But obviously, talking is a key requirement of doing what I do. And I remember a few years ago, I was in the thick of COVID, had a really, really bad case of COVID, and we still did the live show. So that's kind of like my high watermark that I've got to get back to. No sickies, unless it's absolutely necessary, as you know, with running your own business. G'day, Navar. Good to have you in the chat, Navar. Navar, founder and chief technology officer for Navexa, which we'll bring up. And that's actually a good segue. Thank you, Navar. Without even trying to do this, you've brought it up for me. So if you're watching the live show like this on your YouTube, or if you're on Facebook, or if you're on Twitter, the best place to head is to YouTube, because if you go into the description field here, you will see all of the tools that we use each and every week for the live show. If you ever get stuck, you can go to rasmedia/live, and it also has all of the partners, and you can click on the links and you get a deal. So you can also, like, I'll put this in the chat right now, but if we click on this, you can click on the link to say Navexa, seeing that Navar's here, and you can get the deal that's on offer. Now, we don't make anything from this, it should be known. Obviously, I run Rask Invest, so we make money from that. But from the rest of it, we don't actually make money. So it's just a discount for you. We will also, thanks to Navar, we will also start tracking the fake news portfolio. Maybe we could call it the alternate facts portfolio. I don't know. It turns out, so many of you asked last week about maybe we should name the portfolio that we're going to build together after Mitch's cat, because Mitch's cat always seems to get on the Rask Lives and these types of things. Turns out Mitch doesn't actually call his cat, or the family don't actually call the cat by its name. They just call it, I think, Tabby. So bring that up with Mitch on Mondays. But that wouldn't have been very fun if we're just like Tabby portfolio. It wouldn't have made a lot of sense. But there is maybe Mitch can bring up a bit of a reveal about old Tabby in the future. I'm sure you will find it if you watch enough of Mitch's shows on Monday. But anyway, all the stuff that you need that we reference on the show is here. If you use Navexa for tracking your portfolio, super guide who will be introduced in coming weeks for all things retirement and superannuation. It's actually a wonderful resource. Pocketsmith I've started using, and I've just been absolutely blown away by Pocketsmith. Then Perla, which we dive into as a brokerage platform as well, which you all know about. Obviously, Rask Invest is the portfolio that I manage. Thanks, Naval. You do what you can. You definitely do, mate. You do more than that. Thanks for the well wishes. Joining Navexa today, says Jackie. Wonderful. Well, Naval's in the chat if you have any questions. Financial Freedom, I used the link in this chat to connect. The link from the email didn't bring me here. Okay. Sorry. So apologies for that. We did have to do a few changes at the last minute, so that may explain it. Anyway, we're going to get on with today. We've got a lot to get through. I'm starting again with the Charlie Munger quote. The big money is not in the buying and the selling, but in the waiting, which is going to be evident today. A lot of the things that I talk about today are not just for beginners, even though that's kind of what a lot of people are probably here for. But I find that when it comes to a lot of things in life, the most wise amongst us often simplify things down to a sentence, just like this one, and it doesn't take with you immediately. And so realizing and appreciating the true power that's in this one sentence might take you 10 years of investing to actually realize what Charlie was alluding to in his book, Poor Charlie's Almanac. But I've dotted some really key quotes, and we're going to talk through some slides today. And those slides are the result of my 10 or nearly going on 15 years soon, I'm guessing, of reading, learning, studying, interviewing. So a lot of the things that we talk about today need much more time than one moment on a slide, but I'm going to try and bring that to you today. So if you haven't already subscribed, hit subscribe on YouTube. If you're on Twitter or Facebook, I think those have the equivalent thing, but definitely YouTube is the place to go. We upload 5 podcasts minimum a week. Normally it's more than that from all the different hosts. There's general finance warning. Obviously, if I do answer questions, which I will be taking questions, I don't know your personal circumstances, so be sure to seek out a financial advisor who can take those into account, as well as your goals and your risk profile and these types of things before acting on the information. Final disclosure, Rask Invest, which I already have mentioned, is a financial product, and it has its own PDS and TMD, which is available on our website. You should read that before investing with me and the team. So the format of the live shows is pretty simple. It's fun, it's free, it's practical, there's no bullshit, and it's every Thursday at 12 noon. It's available on replay no matter where you get it, and you can join our community for free to keep the conversation going, and it's not just for people that invest with us. As I said, it is free. So today we're going to talk about why invest in shares at all, long-term performance of the share market and why that matters, how to invest in shares, the ASX, how to use ASX shares for passive income. I'm going to talk about more than just shares when it comes to that point. Franking credits. We're going to ask ourselves, is the share market just like gambling, like all those people tell us? How much you actually need to invest in shares? And then I'll answer some questions. Obviously, I'll answer questions as we go through. So let's start off with the most obvious one. Why the heck are we even talking about shares at all? Many of you will know this chart. Maybe if you are in the chat and you've seen this chart before, tell me, when did you first come across this chart? This is a chart from Vanguard. It's the Vanguard Interactive Volatility Index charts. I think that's what, let's bring it over. Yeah, it's the Vanguard Digital Index chart now, they call it. But it's a volatility index chart, which is classic finance, making it so bloody bamboozling for anyone to understand. Basically, it just shows the returns of the major investments. And you can see here that you've got Aussie shares. I've blown this up a bit for you. You can see Australian shares returned since January 1970 until the 30th of June 2024, 9.6%. International shares 10.1, US shares 11.9, Australian bonds 7.3, cash 7.3. Keep in mind with the bonds and the cash, interest rates used to be 17%. So there was a big period of time there where those things looked really good, particularly in the 70s and 80s. But obviously they aren't nearly as good as that now. They're better than they were a few years ago for us here in Australia, but not nearly as good. You can actually bring property into this equation when you bring it up to, I think it's around 1990. You can start to see the returns of property. This is not like your mum and dad's place or your place. It's actually an index of property. So like REITs, the real estate investment trusts that you can buy on the stock market. That's the only way to really track Aussie property back that far. So unless you've got a huge database. So you can see that shares did better than property over the period that we've just analyzed. They did better than everything, as is almost always the case over 10 plus years. So people often are blown away by that. They're like, well, shares are risky. Yeah, well, shares have done the best out of everything. So I guess there's that. Probs introduced to you by me. That's Financial Freedom, no worries. Yeah, so the interactive charts, Vanguard does this, a bigger chart that you can download as a PDF. You can print it off. You can put it on your wall next to a picture of Warren Buffett in your shrine if you really want to. And that picture actually shows all of the different prime ministers, all of the different, negative events that have happened. One thing that's really cool with this chart is you can click this box which says examine falls of 5% and then the recovery. And I've showed this before. So basically what it shows is like during the global financial crisis, which was here, you can see that it fell in, let's say it was like 1 year, maybe a year and a half, but it took maybe like 6 years to get back to that same level, right? That's really interesting because it shows you that falls are quicker than you think, so they don't last as long, but the recoveries are gradual. That's why everyone is always so scared on the way back up, because it takes time to get back to where the crash happened. And it's not just that one. You can see that play out again and again through time. And this is just Aussie shares, right? If you go like 20% falls, you'll see since 1990, there have only been 2. And the one in COVID was so short, you can barely even see the fall. Obviously, you can see it in the line. But that's the point, is that the falls are dramatic and the recoveries are slow. That's why when people always say to me, oh, the stock market's near an all-time high, I shouldn't invest now. That is the worst possible thing that they could possibly think. Because if you look at any stock market chart over the long term, it is almost always from bottom left to top right. That would mean, with just simple like understanding of how charts work, that would mean that it's almost always near the high. It's almost always at the top, because that's the way that they go. So to use that as a reason not to invest, it's actually like nonsensical when you think about it. So when someone says to you, oh, it's near an all-time high, I shouldn't invest now, you should be saying, yeah, no shit, Sherlock. Like, of course it is. That's where it should be. Maybe you can be a bit more polite than that, but we've got limited time today, so I'll just fill you in. So shares probably have been the best investment over the long term. And one of the reasons is they don't require maintenance. There's no tenants. You just buy the shares and you pay a small fee. There's a little fee that comes out if you own ETFs, and you get passive income. And as Financial Freedom's just said in the chat, dollar cost average all the way. Yeah, because I'll come back to that actually in a bit. Financial Freedom, you've kind of jumped 10 slides ahead of me, which is good for you. I'll fill everyone else in a moment. So the thing about shares is quite interesting that people tend to forget, is that you actually know your downside. Now, I want to be really clear about this. Shares can be risky. We'll talk about that in a minute. But you know that the maximum you can lose is 100%. Now, you might be thinking, well, and 100% is a lot of money to lose. Yeah, but you don't own just one share, right? So we know that the downside is 100%, but the upside is significantly more than 100%. There aren't many things in your life where you're given an opportunity to say, hey, you could lose everything, but you could make 30 times your money over the next 20 years. You don't, or whatever it is. That's just a hypothetical. But there aren't many opportunities in your life where you're given those odds, where you're given that choice. But shares are one of those things where people tend to think, well, there's a lot of downside. And we'll come back to the reason why it's not 100% downside. In fact, it's not that at all if you know what you're doing. So the final reason that people invest in shares is because you can make money while you sleep. It's not like most residential property that you might buy, in that you go backwards and you have to wake up tomorrow to work just to, make the loan repayment on the negatively geared property. From literally the day one that you buy shares, you're starting to make income. It might be small to begin with, but eventually it's substantial. So let's look at this a different way. So this is just the Australian market, and this chart comes courtesy of Market Index, which is a wonderful website. If you haven't already checked it out, marketindex.com.au. It's a wonderful website for data on companies and different types of things. It's now part of Livewire, if people are familiar with that. Livewire bought it a few years ago. So one of the things, probably my favorite, it is my favorite page on the whole entire website, is their statistics page. It's just /statistics. And I've brought this up before on the show, but it's worth repeating now. This chart here, this, I guess, column chart shows you the returns of the stock market, the Australian stock market, over 124 years. So if you thought, oh, Owen, you're just cherry picking stuff back to 1970, which is when the first available data, I couldn't go back further than that. So I do apologize for only having 74 years to make my point. But let's say, if, for example, you wanted to go back, sorry, not 74 years. Let's go, 74 years, 54 years. So let's say we want to go back 124 years, and you think that might be more substantial to make your point. And what we can see in this chart is that there's a bunch of green blocks stacked up on each other. They're the positive years, and the red ones are the negative years. On first glance, you can see that it looks like a normal distribution, something you learn in statistics. It looks like a bell curve. On the right-hand side, you can see that there are more green than there are red. But if we zoom in, this is where things get really interesting. Normally, when we do statistics at high school or university, we realize that the average is like the middle, it's 0. The average is actually, for stocks, not 0. The average for the long-term returns of the stock market is actually positive 13%. Now, that's not necessarily going to happen in the future, but my point is made that the average is not 0. So when people say, oh, Siri's talking to me. Old Siri always checking in with me. When people say to you, the stock market is a zero-sum game, meaning that there are no winners and losers, or there are equal amounts of losers and there are equal amounts of winners, those people clearly haven't seen this chart, which shows that if you're patient, there actually aren't, it's not zero-sum. There are many, 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 many more winners than there are losers. The problem is the way people approach the stock market, which we'll talk about in a minute. So this is a fascinating chart once you actually understand it, because if you've taken my 2 charts already, you've already probably had your mind blown, because you're like, okay, it's the best thing to invest in. And even if I do the average thing, it's probably going to be positive. That changes how I approach it, right? Simple, join the dots, right? If your mind is getting blown, that's okay, because it took me years to try and oh, okay, I could just do that and they'll be fine. So why don't people just do that? Why don't people just do this thing that seems remarkably simple to do when it comes to investing in shares? The reason is that our monkey brains are wired to negativity. It's why all the newspapers want to sell us garbage. And if you look here, the data suggests that not everything is smooth sailing. So approximately 1 in 5 years is red. Some of those red years are back to back. Like 1973, it fell between 20 and 30%. And then the following year, it fell between 20 and 30%. So you were down over 50%. Imagine how horrible that would feel. And people would naturally have freaked out and got out of shares and lost money, bought at the top and sold at the bottom, told their kids and their grandkids that shares are like gambling. Don't do it. It's risky. Stick to property. All these types of things you've probably heard 150 times before today. But the reality is that's not the reality. The reality is that most of the years are good. It's just some of the years are bad. It's like when you go to work this week, if you go to work, some days will be good, some days it will be bad. The Happiness Trap, which is a wonderful book, it talks about the things that there are many different things, but one of the things is that not every day that you wake up, you will be happy, but you can still be a happy person. And the reality is you can still be making money from shares, even if today you don't make money, or this month you don't make money, or this year you don't make money. But because our brains are wired to the short-term negativity, we forget this. So we have to zoom out. Warren Buffett has these 2 remarkable quotes, which tie in well with this chart. He says, the stock market is a device for transferring money from the impatient to the patient, from people who think the stock market is for trading, and then they take that money and they basically give it to brokers, they give it to the tax department, and they give it to you as a long-term investor who just does nothing. The second thing is stocks are safe for the long run, and they're very unsafe for tomorrow. You've probably heard us say this on one of our podcasts. You never invest money that you may need in the next 3 or 4 or 5 years. Just don't do it. But people think that they're not doing enough. And then they see everyone else making money. So they then put their money in that they're going to need for a house deposit or for their retirement or for their European holiday or whatever the heck they're doing. Whatever. And the reality is that you don't need to do any of those things, if you're prudent, you don't need to sell, you don't need to pay tax, you don't need to incur extra costs if you're just sensible long-term focus. And I've got a chart that also backs this up in a second. Apologies, my voice is getting a little bit croaky. The bottom line here is that people think stocks or shares are the same thing, are dangerous because they try to trade them, they aim short term, and they don't understand it. Notice how I said 5 years is short term? Most people, when they say short term, they mean under a year. Think about where you will be in 5 years, how old you'll be. If you put money in shares today, that's the person that you're going to be giving that money to. The reality is people try and trade their way to returns. They try and force returns, which doesn't work. And the best analogy for this, excuse me, ladies, is you can't get 9 women pregnant and expect to have a baby in 1 month. That's not the way it works. So the reality is that you can't speed up the process. You just have to give into it and acknowledge that this is what's going to happen. So the question is then no one can predict the stock market? Well, you can predict it. There is a formula for it. And Morgan Housel, in his wonderful presentation, I think I've still got it up. No, I do not. In his wonderful presentation, What Other Industries Teach Us About Investing, had this one slide in his presentation. Morgan Housel is the author of Psychology of Money, by the way, guys. He comes up with this very simple thing, and he wasn't the one that came up with it, by the way. It's just a simple acknowledgement of what actually happens. So you get a positive return from dividends. That's the income that you get from shares, like every 6 months or every year. Then the profits can also go up. Earnings is just another word for profit. Classic finance having 2 different words that mean the same thing. And then there can be a change in valuations. So this is like, for example, when the price earnings ratio, if you're familiar with that, goes up or down. I'm willing to pay you more for something just because you've presented it in a certain way. We'll keep going. Normally where people go wrong is they spend all of their time focused on this thing. They're trying to find cheap stocks. That doesn't work. So again, there are 3 ways to make money from the share market. There's the income you get from dividends. There's the profits. Like if a company gets more profitable, it becomes more valuable. That's different to a share just be going up because it increases in its share price. That's not investing. That's just random. A good example of this is over the past 10 years, Commonwealth Bank's profits per share have only gone up about 12%, but the stock is up over 100%. That means that the valuation has expanded. Pardon me. So the bottom line is the longer that you invest in shares, the less important the valuation becomes. It would still be important if you're buying direct stocks, but it's not as important as you might think. So the finance industry tries to fool you into thinking that the valuation is the most important thing. Let's zoom out a bit. And apologies if you can hear my turkey. It's just outside making some random noises. So amongst me coughing and the turkey making that noise, you've got the full farm for you today. So time is your friend. So this is a different point of view. So if we think about this as if you're buying an individual share, you get a dividend from it like Commonwealth Bank. Commonwealth Bank does more loans, so its profits goes up. But someone else is also willing to pay you more or less for the same shares. Let's zoom out and let's take the stock market as a whole. So what this is also from Morgan's presentation, but it references Professor Robert Shiller, who's a fantastic finance professor who spent a lot of his time also talking about property as much as shares. So he's like a finance professional in general, but he does a lot of calculations. One of the things that he showed quite a few years ago, if you took all of the data on the US stock market from 1871 to 2012, I don't know how long that is. It's a long time off the top of my head. That's my answer. What he did is he got the returns of the investments in the S&P 500, which is the top 500 shares in the US overall. And what he analyzed was that if you held shares for 1 year, 2 years, 5 years, 10 years, 20 years, 30 years, or 50 years, any single combination of 1 years, 2 years, 5 years, 10 years, any single combination, what was the chance that you experienced a negative return? And what was the maximum amount that you would lose? And if you invested, so let's just put this in an example. This is the easiest way to understand this chart. Let's say, for example, you picked over that time period, 1871 to 2012, you picked the exact worst year to invest. Just 1 year, you would have lost 38%. If you picked the exact best year of that whole period was like 140 years, you would have made 53%. But if you then use a 2-year period, the maximum loss that you would have received for any 2-year period, like say 1972 to 1974, like that 2-year period, you could have lost 28%. You could have gained 44% in the best year. 5 years, any 5-year period in that time, negative 13% would have been your worst return. Plus 23% would have been your best return. And what you're noticing here is you're noticing that the longer you invest, the less chance there is of losing money. So in this particular period, in this particular sample, and again, this might not be exact replication of the future past performance, not negative future performance and all that. But what it shows you is that if you just take a very long time horizon, the chance that you'll actually lose money in any time period in this 140 years is almost zero once you get to 20 years. Well, it is zero according to this data. But after that, it's only positive. In fact, the worst years, if you invested for 30 years, was still positive 3.2%. So I hope that makes sense. If you have any questions on that, let me know. I can see a question is coming from Jackson. I have 60K. Where would you put it? I'm thinking 35K in IVV, 15 in STW, 15 or 10K in IAA. Jackson, I can't give personal financial advice here on the Rask Invest live show, but I can show you in a little while, and everyone that will be watching this, you'll see actually where our portfolios are invested in a little bit. So I hope that will help you. I'll continue on. How to invest good. So Charlie Munger has this brilliant quote, which is invert, always invert. I prefer the slightly extended version, which is that it's easier to avoid stupidity than it is to seek brilliance. So what financial freedom, you've said, can we add the last 12 years data to that? Yeah, I'm sure you could. I haven't done it. This is Robert Schiller's work. I think there's an updated version on Morgan's Twitter or on Robert Schiller's Twitter. Yeah, Paradox, this should be noted as investing in the stock market overall, not an individual company. Yeah, good point. I'll come back to that in a little bit, Paradox, so bear with me. So I said before that Charlie Munger's quote, it is easier to avoid stupidity than it is to seek brilliance. Another analogy, which comes from Pat Dorsey, who's the former head of Morningstar Research, he used to say that investing is kind of like playing tennis. If you were to go out and just try and hit the ball over the net, you'd probably be okay. But if you try and hit an ace on every serve, you'd probably stuff it up more times than you thought. So for most people, just getting the ball over the net is probably the first thing to focus on. And the way you do that is you just avoid all the common mistakes. So trading, gambling, and investing are different things. I'll come back to that in a minute. But anyone that talks to you about stock trading as a fundamental principle, they're not investors. They're trading stocks. They're speculators. It's different to investing. Gambling is a horrible thing, and you'll see why in a little while. Number two, start with the end in mind. A lot of people, when they come to us at Rask, they don't actually know what they're doing. They just know that they should invest. So I say to them, well, what life do you want? And let's work back from there. Number three is start small and add slowly. A lot of people, we spoke to one lady the other day who had been listening to investing content or reading investing content for over 20 years and had never invested. And she finally invested actually after COVID, which was wonderful. She listens to our finance podcast. And it was actually, I asked her like, why? And she's like, I don't know, it just seemed like the right time. I feel like a lot of people over complicate things in its decision making 101, but you can start with $500 or $50 or whatever. Just start and get used to it. I would say learn the essentials of investing in finance in 15 minutes per day for 3 months. You probably get a lot out of that. Listen to a podcast, read a book, whatever. I've got some recommendations if you want books or podcasts. Number 5 is use ETFs for your core portfolio. I'll come back to that. Find people who you can trust, because a lot of the stuff that you hear in finance is not acting in your best interests. A lot of it's acting in their best interests. There's the famous quote of like, I think a journalist goes to a fund manager and the fund manager's showing them a view of the marina and points out everyone's yachts and says, that's such and such's yacht. That's such and such's yacht. That's the stockbroker from down the road. And the journalist says, where are all the clients' yachts? The reality is that the finance industry eats up a lot of it, or has eaten up a lot of it through fees. Avoid anything to do with WhatsApp, TikTok, or social media ads. And the reason I bring this up is a specific thing. I don't want to put this in, but I kind of have to, is that investment scams are dramatically on the rise in Australia. The only way to know you're dealing with someone legitimate is to go to the asic.gov.au website and check something called the professional registers. And you can search for a company name or the AFSL. Number 8 is assume most people in finance need to earn a fee, and that's okay. Just know what it is. So there's been a lot of like people, consumers that go to the finance industry and they're like, oh, I need to search for the lowest fee. I'd say that's the wrong approach now. Thanks to the wonders of like Barefoot Investor and Vanguard and these types of organizations, fees have come dramatically down and it's been wonderful and consumers are smarter than ever. But I think we're at a point now where fees don't necessarily need to go lower. I think it would probably be riskier to go with a lower fee option because the business that you're dealing with may not actually be profitable, which can then create heaps of issues if they go out of business. So you're better off finding someone and something that offers fair fees and you just know what they are. That's also point number 9. So trading versus investing. So now we start to talk a little bit about shares and portfolios. So a common question I get is like, what's the difference between trading and investing? And Heath, it's good to see you in the chat. Thank you. Heath, if I'm not mistaken, you're qualified to give financial advice and you're an industry participant. It's great to have you here, mate. And you say, I find that that is one of the biggest hurdles to get over with clients. They take in so much information and try to overcomplicate their investing. Thanks, Heath. It's so great to have you in the chat. And wonderful. Heath's on Twitter. I'm guessing you're on LinkedIn too, Heath. So feel free to chuck that in there if you want, mate. So trading versus investing. This chart is slightly pixelated. It's from 1993 to 2012. And yes, financial freedom, before you ask me, this chart has actually been produced more recently and it's produced here in Australia. So I think it was BetaShares who did it. Schwab market timing. Yeah, okay, here we go. So BetaShares, so Annabelle wrote this article, which is great. Is it this one? I thought it was maybe, there's an article, I don't have it on me right now, but there's an article that replicates the same chart that I'm about to explain to you on the BetaShares website, but for Australian investors. So what this chart shows is it shows the period from 1993 to 2012, and it shows 5 different investors. Those investors either just put their money in cash or invested in the share market, being the US S&P 500. Now, there are 5 different investors, and they're each given $2,000 at the start of the year, so January 1st. At that time, perfect timer right here, happens to have these binoculars where they look out to every single day of the year, and it tells them which day of the year is going to be the lowest day of the year for the stock market, and they buy on that day. So they have perfect hindsight and foresight, and they buy on that day, which is obviously impossible, but let's play along. The other person just invests their money as soon as they get it. They get it on January 1st. They invest it in the S&P 500. $2,000 in the door, in the door into the stock market. The next person breaks it up and puts it in over the next 12 months. So a bit this month, a bit next month, every month, and so on. The bad timer, well, she's especially unlucky because she has the binoculars that number 1 has, but has them turned around the wrong way. So every chart that she sees is upside down. So she actually picks the worst point of the market to buy. She picks the day that is at maximum top and then watches it fall immediately. Kind of like Murphy's Law. We could call her Miss Murphy, right? So she has the worst possible timing. And then there's finally the investor who said, it's stocks. It's all too confusing. I'll just keep my money in the bank. No worries. That's the stay in cash one down there. So over 20 or 30 years, or however long this is, 20 years in this case, what we can see is that obviously the person with perfect timing wins. That would make sense. They're perfect, right? But interestingly are these two, and I'll bring my little Mr. Squiggle out. I won't use blue because that's too obvious. I'll bring Mr. Squiggle out and I'll circle these two. Well, that's not a circle. That's a rectangle. Now, what's really peculiar about this chart, and what you probably don't have noticed it straight away, but what's really interesting is that the difference between that and that is this bit right here. It's a tiny, tiny, tiny amount. In the grand scheme of the multiverse, as I say to my sister who likes Doctor Strange, in the grand scheme of the multiverse, it doesn't matter. No one cares. If you think that timing the market and picking the bottom day every day of the year to buy is the most important thing, you are wrong. What matters is just investing. That's what matters. It doesn't matter that you pick the lowest day. It's kind of like picking up pennies in front of the old steamroller analogy. It'd be like picking up pennies and then spending the rest of your year looking at a computer screen when you could be out playing golf or walking the dogs or spending time with your family. Don't worry about it. Just invest and get on with it, because the data shows that the actual benefit of having perfect hindsight, which we know is impossible, is actually not even worth it. Even if you could do it, like just go and buy it. Or if you're not interested in investing $2,000 in one go, just break it up and put it into smaller parcels and do it over time. Financial Freedom said it before, dollar cost averaging works. Like I would just invest every month, a little bit of my money every month. Simple. It's done. Sure, sometimes it goes down, sometimes it goes up. You get good prices, bad prices, you get a bit of everything. But as we know from all of the charts shown above, it works. So if you just invest, it's simple, rather than trading. So there's a really interesting study. I'll bring this up. So obviously I'm still talking about the stock market overall. I'll see if this one comes up. Let's see if I've got it here. Sorry, I should have. I can't find it right now. There was an article that I wrote many years ago, and it referenced a Massey University academic journal. And I'll see if I can bring it up. I might actually have it here in Canva, so I'll just have a quick look. I think it's Massey, like that. I think it's spelled that way. Oh, yeah, here you go. So this is an academic journal, and it said over 5,000 popular technical trading rules, that's like trading rules, are not consistently profitable in 49 countries that comprise the Morgan Stanley Capital Index. Once data snooping is bias is accounted for. Anyway, it goes on and says that we do show that over 5,000 trading rules do not add value beyond what may be expected by chance when used in isolation. So in short, trading, while some people can be correct based on what they call data snooping, which is kind of like randomness, you can make money from trading. It's just incredibly difficult. So if you speak to someone who says that they're trading stocks, they might get right for a little while, but statistically over time, it becomes less and less and less effective. And that's before they take into account taxes and costs, which are real things. Okay, so if we keep moving on, many of you know that we use a core and satellite approach at Rask. It's exactly what financial planners throughout the world use. They just call it SAA and TAA. That's the only difference. So they call it SAA or strategic asset allocation. Geez, that A is small. And TAA, which is tactical asset allocation. We can just call it core and satellite because it looks like, if you build it like a pie chart, it kind of looks like the Earth. And then there's like little moons that go around. So core and satellite tends to make sense. Plus, who doesn't love space, right? So in this example, we use core ETFs, so low-cost ETFs. You could use active investment funds if you wanted to, but you can use ETFs because the cost of your portfolio will be lower, and you can diversify across different investment streams. Obviously, we're just talking about shares today, but over the coming months, we're going to talk about everything, including the other stuff that goes into a diversified portfolio. But for shares, you can use ETFs, and it's super easy. But let's say you're like, hey, Owen, I'm buying all the stuff that I'm picking it up. What you're putting down sounds good, but I also like to buy individual shares. And I'd be like, say, hey, so do I. But I don't do that in my core portfolio. I do that in my satellite, and it's with a very small amount of my money compared to what I would do with my core portfolio. And there are many reasons for this, which we'll come up with in just a moment. But if you're buying individual stocks like I am, I put them in here. So I put them in the smaller part of my portfolio, even as a professional investor. And most financial advisors these days use ETFs. They don't use individual stocks because they know it's also too risky. Some of them do for bigger clients, but realistically, most people should just be using ETFs or like really low cost active strategies as well. So what does my portfolio actually look like? Well, you can check it any moment you like. I'm just going to bring it up here. So if you go to the invest.rask.com.au website, you can see it here. It doesn't show you exactly what it is, but it shows you what's in it. So if you go to portfolios at the top, and all these links are in the show notes, and you click on one, let's say you click on this retirement one, which is Terra, that's what we call it. And you click asset allocation, you can see which ETFs we hold. They're right here. You can also see where we've allocated money. So we've got 33% in fixed interest investments, 25% in Aussie shares, 25% in international, and 17% in cash. This is a retirees portfolio, by the way. So you can see that. And you can see the different ETFs that we've got in our current portfolio. So we're not hiding anything. If you want to go and check it out, I'll leave that to you. But we're talking about shares. We're not talking about the whole portfolio today. I just wanted to bring this up because even though we're talking about shares, there are studies that show this is how it's really important to. This is the thing that's really important to remember. So there are studies that show as much as 90% of the return you achieve will come from which buckets you have, not which shares you buy. So what I mean by that is the 90% is this stuff, this decision, not which ones do you buy, but what are you investing in as a whole? That's where the majority of return comes from. Now, this 90% has been challenged a few times by different academics and institutions. And some people say it's not 90%, it's 50 to 90%. But if you think about it, how much time over the past year, if you're an individual investor, how much time over the past year have you dedicated to thinking about how many bonds you have or how much shares you have or how much cash you have? How much time have you dedicated to that versus which ETF to buy, which share to buy, which property to buy, which bank account to go with? Those are the things that seem like they're important, but what really is important is just having some of it. So I'll move on because that's kind of like we can tackle that on Thursday. So let's talk about the satellite a bit more. There was a good question before about individual shares. So if you are going to buy individual shares in your satellite portfolio and we want to be good investors in the stock market, well, one of the reasons that we do that is because we want to buy good stocks, right? Who doesn't want to buy good things? Don't want to buy just the average ones. And if we're going to do that, we'll just go and invest in an index fund because they're pretty good. Through an ETF, that sounds pretty good. But let's say we want to do a little bit better than that. Or we think we can do a bit better than that. Boston Consulting Group, in association with Morgan Stanley Research, did this study from 1990 to 2009. And what they showed is if you took the top quartile of stocks on the market, so you took the top quarter and you took them and you did an analysis of why those stocks went up, what you would have found is that if you were just analyzing them over any one individual year, 46% of the return that you would have got that year, any 1 year, on average, could be explained by the change in the valuation. So this would be like the price earnings ratio, which some of you would have heard, which just compares the share price to the profits or price earnings. Earnings is the same as profit, remember? So if we go to, say, CBA shares And we can see that it has a price earnings ratio of 23. And if we go to, let's say, Westpac, which is its competitor, and we see that it's got a price earnings ratio of 16. Oh, look at that, a Rask article. You can see it's got a price earnings ratio of 16. Some people conclude that because Westpac has a lower price earnings ratio, i.e., a lower valuation, that it is better. That's their logic. The reality is it's not that simple. If you're investing for 1 year, the data suggests that decision of which one has the lower valuation only could explain, normally, like on average, 46% of the return. But if you're investing for 10 years, because you don't just invest for 1 year, you are a long-term investor, it actually the data shows that for the best companies on the stock market, only 5% of the return is explained by valuation. Only 5%. So valuation is less important the longer you invest. Pretty simple. Even if you're investing in individual stocks, it's still important. That's important to understand, especially in the shorter term. But the longer you invest, the less important valuation becomes. But what does become more and more and more and more important, to the point of where it's 89% of the return, which is this bit, what does matter is the growth in the company's sales and also the margins. This is what matters. So this is effectively showing you that the best company is telling you, the best companies, if you're trying to buy them as individual stocks, don't waste your time worrying and obsessing about valuation. That's the most important criteria. It's still important, obviously, it's still important, and cases will vary. But for the most part, for the long term, what really matters is finding the best companies, not finding the cheapest stocks. I hope that makes sense. Now, we're going to quickly go into some income before we call it a day. I'm going to talk about franking credits, and I'm going to lift the lid on something. So a lot of people, when they talk about the stock market, what they do is they talk about the ASX 200. They put that into Google and they see that there's the ASX 200. The stock market is up 0.12% today. The media loves this. And I've tried to show this in this chart here, that if you Google ASX 200, which is the stock market overall, you could do the same for the Dow Jones or the S&P 500. What you will get is heaps of news. So much news, like news from everyone, telling you everything there is to know about the ASX 200. And it's got a little code XJO, which is how you can identify what we're talking about. It's the ticker symbol. See all of this news. If we go in here, we've got even more news. News. But what a lot of people don't understand is the ASX 200 by itself does not include dividend income. So when people study this, they say, oh, the stock market's near an all-time high. You've probably heard that recently. The stock market's near an all-time high. They started saying it recently. I think it was like around here, late last year, early this year sometime. But if you include dividends, I don't think we can do it in Google because that's not enough demand for it. So let's go to... so now let's look at it with dividends included, which seems fair because dividends are paid by shares. Oh, look at that. It's a lot smoother. And it's also been at an all-time high for basically every year for the past, however long this is, 2011. And there's no news. No one's talking about it. Why is no one talking about the thing that includes dividends? It's because it doesn't feed the narrative that people want to know, which is what a stock price is doing. But the data suggests that dividends can make up sometimes even more than half of the return. So I would encourage you, anytime someone says the stock market is at near an all-time high, just to pull up this chart and be like, yeah, well, it's almost always near all-time highs. And dividends are part of why I invest. So it's not surprising to me that they would be so high. So don't just be fooled into thinking that it's the ASX 200. You got to be tracking the total return, which includes income, because as much as half of the return that you get as an individual investor will come from those dividend payments. Now, sometimes if there was a 10% return, sometimes it's not half. Sometimes you might get 6% from, say, the capital growth, so the share price going up 6%, and you might only get 4% from the income. So depending on the time period, but it can be as much as half. And so as long as you remember that, it is important to not forget the income. But one of the extra things that we have in Australia is we have these things called franking credits. So I've called it a free franking kick for us. Franking credits are tax credits that are stored at the ATO. I think there are only 2 countries in the world that offer this program called imputation. But start here and let's think about it. So a company like CBA, Commonwealth Bank of Australia, makes a profit. Companies pay tax on their profits. So some of that profit goes to the ATO as company income tax, right? And it's stored there. But technically, you over here are a shareholder. So wouldn't it make sense that if the company's already paying tax, then I pay tax on the income that the company pays me after it's paid tax? That sounds like double taxation. So the ATO and the government has introduced a program called imputation, and the most common phrase you'll hear is franking credits, and these are the tax credits themselves. So what happens is if $100 was sent to the ATO and you're entitled to that $100 tax credit, what you can do as an individual, this is you, is when you do your tax return, you tell your tax agent, and hey, I invested in some CBA shares and I think I got some franking credits. So you might have got your cash payments throughout the year from your shares, but you will also be able to claim back the $100 if you say you're a retiree, or if you're working like I am. It doesn't always come back as a tax refund. It actually just offsets some of the other tax you might have to pay. So it's held on your behalf at the ATO until you claim your tax return. So let's say for round figures, let's say you have $150 of tax to pay, but there's already $100 at the ATO. Oh, geez. There we go. So that means I would only be out of pocket $50 in tax, not $150, which I thought, because the franking credits have offset that. Here's another chart for you to visualize it. So you generate franking credits. As the company's paying tax throughout the year, that's generating more credits that go to the ATO. And then when you do your tax return at the end of the year, the franking credits are released and refunded to you. Or refunded, it could say, or refunded. So you basically claim them back. One of the questions that I get is, can you get that from ETFs? Yes, you can. Can you get it from active funds? Yes, you can. Can you get it from property? No. Can you get it from US companies? No. It's only an Australian thing. So a couple more slides. Are shares like gambling? Well, there are a lot of things that are similar, like they both involve numbers, and people use their wallets or their digital wallets to access money. A lot of people don't understand it, and it seems intimidating. So there are a few similarities, but that's basically where it ends. Approximately 72% of Australians have gambled in the past year, which is extremely concerning to me when we consider that not that many people have invested, because stocks are like gambling, which is bizarre. But I think there are a few reasons why they're not the same. First of all, investing is a long-term pursuit. And as everyone now knows who's stayed with me throughout this hour, investing is actually wealth creating. So it's an informed decision that is made by you into productive assets such as shares. Whereas speculation is what happens when you go to the casino or to the trotting yards. There is some skill involved in poker that's been pretty well established, but outside of that, literally everything else is not. And one of the reasons that you could probably think that is in poker, you're playing against other humans. You're not playing against maths or a computer machine that just is rigged against you. Number two is that the stock market has a track record of wealth creation. i.e., this and this, the stock market has proven itself to create wealth over the long term, not in the short term. Gambling cannot, by its very nature, create wealth for more people. It simply just redistributes wealth if someone wins. So a loser sends money to a winner. And the key thing is that it's not a zero-sum game, because on average, people have to lose. Because if they don't lose, the house goes broke. Pokie machines wouldn't exist if, on average, people won. You can understand that. Number 3 is that information in the stock market is fair for everyone, and everyone has the same access to information. In the gambling, the house sets the odds. Number 4, this is a really interesting point that a lot of people don't think about. Remember how I said before that the maximum you can lose in shares is 100%, right? Well, there's a lot of good research that shows if you diversify a portfolio like this, the maximum, it's unlikely that you will lose all of your investment, but you can still make most of the upside. So you can actually change the way a portfolio looks and how it reacts through some pretty simple things. And remember this here, that's basically showing you that the odds are in your favor the longer you invest. Now, the difference is in the stock market and in gambling is that the gambling companies will tell you that you can limit your risk. And all they do is they effectively just limit your bet sizes, which is not changing the risk return. It just changes the amount you put in. So it doesn't actually change the risk at all when you think about it. It's still the same bad bet. It's just you're doing less of it. Number 5 is that regulation in the stock market is built for disclosure. It's regulated a well-functioning system where most regulation, there's really 2 prongs of regulation in gambling. One is for fraud, to stop fraudulent companies providing gambling. And the second thing is more just around advertising to try and protect kids. And number 6 is the time horizon. Most people that are betting for a short-term payback, which is obviously good for the stimulus in our monkey brains. But as we know, long-term investing is the only thing that really counts. Number 7, and this is a thing that probably all the Rask community gets, but not many people outside of that seem to understand when I talk to them about it, is if you create money by investing in the stock market, you can then use that money to invest in good things that support your community or your family or other people around you. But more importantly than that, when you invest in companies, you actually support the companies to solve communities, to solve society's problems. So you might not think that investing in Commonwealth Bank is good for society, but how else would a lot of young people be able to afford to buy a property in Australia if not for a mortgage? Who else would do it if not banks? Probably the old fella with the baseball bat or the knuckle dusters would lend you money, which is not a great outcome for society. And so by investing in good companies that change the world, whether it's through an ETF or directly through their shares, you actually contribute to society. Whereas with gambling, all you do is contribute to the gambling company's bottom line. And how do you know that? Because you can just go and invest in those companies on the stock market and see their profit margins to know how much they take from people. So gambling is not like shares. And in summary, it's better for society if you don't gamble and you just put the money in the share market. But obviously, there are a lot of vices that exist in this world. And there are some wonderful resources. If you or a family member or a friend suffer from gambling addictions, they're horrible things and they're real things. But it's not something that you should be ashamed of. It's something that you can deal with and manage through time. And I think the saddest fact of all is that around half of our young people have gambled in the past year. And that is on the rise dramatically. And right now in the Australian government, they're debating in the Senate whether or not they water down some of the proposals that are currently in front of it, which would stop gambling companies from advertising on live sports and these types of things. Hopefully the Senate can pull their heads together and realize that how horrible it is for our society to allow gambling companies to advertise where kids see sports stars and these types of things. Finally, some FAQs, and then I'll get to your questions. FAQs, frequently asked questions. You need an online broker to buy shares. That's how you buy them. I would choose a broker which offers a HIN model, a holder identification, or chess, like the game, CHESS, chess sponsorship. It will cost you more to buy and sell the shares, but as we know, the cost isn't everything. Security is the number one thing, I think. Avoid any broker which talks about trading rather than investing. So if you go to their website and the first thing they say is trading, avoid that one. Number 4 is it's typically $500 you need to get started if you want to use a HIN-based model. However, there are some great solutions out there for broking platforms that don't require $500. Platforms like Perla Micro, Raise, and Sharesies. I do prefer a HIN-based model, just as an FYI. Number 5 is taxes required. And so you can use tools like Navexa, which is the tool we're using to track our live share portfolio, which we're going to start building over the next few months, which you can visit on the website and find here. The other thing to keep in mind is that just take your time. You don't need to rush into investing in shares. People think there's like some urgency, like the stock market's going to crash, it's going to go up, it's going to do this, it's going to do that. It'll still be here, I'm pretty confident, in another 50 years, so don't need to rush it. On the right-hand side here, this isn't a recommendation, but you can see when we have members or people who create accounts at Rask, I think this sample here is like 2,000 or 3,000. I don't know the exact number of people who have filled out our survey for this one, but it shows you the most popular brokerage accounts in our community. CommSec, Self-Wealth, Perla are the top 3. Unsurprising given that, we've done a lot of work with Self-Wealth over the years, and Perla is a long-term advertising partner of our finance podcast. CommSec is the gorilla. And yeah, there's a long tail down there, but that's it. So I do have some questions that have come through, so thank you. I've probably got about 10 more minutes, guys, before my voice completely runs out. So thank you for everyone that has asked questions. So Heath, you said, yep, you are an authorized rep, but love the Rask content and sent many novice investors to your website. Thanks, Heath. Love that, mate. And thank you for following up. So Chant US81, you said, I've had IVV, VAS, and IAF for a year now. I'm looking for an ETF that's international, excluding the USA. I'm thinking FEMEX versus VEU. Any insights from you, Owen? Chances, obviously I can't give personal financial advice, but what I can do is I can talk about the US market overall. So the VGS ETF, which you haven't mentioned. So the Vanguard VGS ETF is probably Australia's second most popular or third most popular ETF. This invests in the whole world ex-Australia. Pardon me. So this ETF does include all the big US companies, but importantly, the thing I wanted to talk to you about is its diversification holdings. Not that, this here. So you can see that 76% of it is in North America, which is basically the USA. There's a little bit in Europe. There are options which you have laid out. I think that it's important to understand the cultural differences between markets in the world, and also the kind of legal risk that investors might expose themselves to when they invest overseas. And I think one of the key things is that there's a very good working relationship between Australia and the US. Sure, there's withholding tax that you'll have to pay. The W8 Ben form can help with some of that. I don't actively invest outside of the United States when I look overseas, because one of the things that I've realized through our research is that about 30% to 35% of the companies in the US, so companies like Microsoft, Apple, Nvidia, Amazon, take your pick, right? About 30 to 35% of their sales, so these companies, their sales comes from outside the US. So if we looked through a portfolio, even though the ETF might be in the US and invest in US shares, you actually get global diversification. So I hope that makes sense. Now, some people do use this VGS ETF. Some people use, I think it is VEU, which you've alluded to. Many people use this to sit right beside IVV. We don't use it. We do use, we disclosed recently that recently switched to this emerging markets ETF from VanEck. It's a bit complicated to explain in a few minutes, but that's the that's the gist, mate. So okay, so Sarah over on Facebook, you said thank you. Always get such great content /info. Thanks, Sarah. Over the last year, have learned so much. Thank you so much, Sarah. That's really lovely, and thanks for joining us over on Facebook. Tim, I thought franking credits were only 30%. I received a dividend of $53 and 23% drinking credits. That's more than 30%. I'm just trying to do the maths. So I received a dividend of 53 and 23, which is 76. And you received $23. That's about right, mate. So if your total dividend was $76, as in $53 of cash dividends you received in your brokerage account, and pardon me, $23 of franking credits. So it looks something like this. Get rid of the ASX. It's about 30% by my quick calculation. I hope that makes sense, Tim. Emily, thanks so much. I'm sick of feeling scared and not starting because I'm unsure. I just need to pick a platform. I've been told ComSec is good for a starter. Pardon me, and just invest in index funds. So nervous. I don't think I will feel confident enough for a long time. Pardon me. So I have to jump in and take the risk. Yeah, a lot of people experience similar types of nerves, Emily. I don't want to play down what you're going through with this, but if you think about what the media has trained us to think about shares and investing generally, or even what Hollywood tells us, it's like Leonardo DiCaprio taking drugs and ripping people off in Wolf of Wall Street, or The Big Short, where there's like a massive apocalypse about to come. From Hollywood down to your local barber, everyone's telling you negative things about investing in shares. It would make sense that we have a negative perception and it makes us quite nervous. But there are two other things at play here. Number one is that we have a fear in Australia, a thing that happens in Australia, which is that we don't talk about money. So a lot of data shows that if parents talk to their kids about money, those kids are more likely to feel secure and financially okay, even if they're in the same situation. And the other thing is that it's a lot of people feel nervous when it comes to not owning individual things. A lot of people feel vulnerable when they talk about things. Mel Brown, who's I think she describes herself as financially fierce or something on Instagram. Mel Brown's a former financial advisor and a great content creator nowadays. And she once said, I think it was on Triple J, that people would rather stand naked in a room full of strangers than talk about their budget or reveal their budget. And I think that that's a real problem that we have. So just speaking openly to other people and hearing about their experiences is really important. And that is what the next comment in the YouTube says from Financial Freedom, who says, I was you about 2 years ago, happily investing fortnightly now. I chose sharesies based on what I had to invest. How often, fees, etc. That's great. Wonderful feedback in the chat. All right, last question before my voice completely gives up. Matthew, you say, so moved early by a week and got the dip of the A200 ETF, but curious, I was looking to add SCHD and O to the portfolio as I can do fractional shares. Is it wise to diversify into US shares as well? Matthew, so a lot of people talk to me, they say, hey, Owen, I can use my brokerage account like ComSec or Stake, Perla, whatever they use, Selfbot. I can buy Australian ETFs and I can buy US ETFs, which one is worth going with? So you can buy the one that's on the Australian Stock Exchange, the ASX, or someone can buy one that's on the NASDAQ Stock Exchange or the New York Stock Exchange in the same investing account. Now, you've got to remember that what happens when your money goes into those investments is that money doesn't just stay in the same place. Like if you go into an Australian investment, it stays in Australia. If you put that money into a US investment, something has to happen to make that money go to the United States and invest in those shares. So what happens is there's typically a different custodian, a company that holds your money. There's a different administrator or company that administers how the portfolios are managed. It has to cross currencies at some point, and so on and so forth. But what also happens when people invest in the United States is they also expose their portfolios to something called withholding tax and another thing called estate taxes. We're very lucky here in Australia that the estate taxes, when you die, aren't that bad. But in the United States, that's simply not the case. And the United States can get quite complicated for Australian tax residents investing in the US. Now, this all might seem like I'm going down a rabbit hole and there's no light at the end of this little rabbit hole. But the reality is that for the extra tiny little fees or the extra accessibility that I get from investing in a US brokerage account, it's simply not worth it for me. Not for my ETFs. I just build an Australian ETF portfolio. Like if we go, I'm not telling you what to do, Matthew. It's just generally speaking. But if you go to our website, you'll see all the ETFs we hold. None of them, like all of them, are Australian. They're all tax residents of Australia. These funds, they're all based here in Australia, so on and so forth. Now, if I was buying individual shares, like Apple shares, Microsoft shares, these types of things, I can't do that from Australia because they're not Australian companies. Now, in that case, I would probably be willing to take the risk and the extra administrative burden of investing directly in the US. But for the most part, I do not. I hope that makes sense. It's just how I do things. It's not right or wrong. It's just how I think about it. But that's a good question. And on Thursday, ladies and gentlemen, we will be back to talk more. And there will be an email that goes out for anyone that's on the Rask mailing list. There will be an email that goes out for Thursday's live. It's at 12 midday, same time, but on Thursday. Today's session was obviously from last week that got pushed into this week because of my laryngitis. But there's everything that I've referenced are in the YouTube description. So if you come in here and you click on the description, you can see that here. You can click the links. You can sign up to Pearl. I think you get some free trades. Pocketsmith, there's a discount like 50% off. This has blown me away how good Pocketsmith is. You can also find out more about how to invest with us. I think there's a link here. Yep, there's a link here to go to our website and you can see the portfolio. I'll just bring that up there so you can see what the portfolio looks like. That's actually a real portfolio with some cash in it. What else? There's a bunch of other things there like financial planners if you need to connect with them. And of course, you can take free courses. Finally, you can also just jump over into the community if you have any questions that I didn't get to. Like anything that's not related to Australian shares, I obviously wasn't keen to answer today because we're talking about Australian shares. But yeah, you can jump over, you talk about property, you can talk about the best spice mix for eggs. There you go. You get it all on the Rask community. So that's that. Thanks, Heath. Thanks for the kind words. And Matthew, Emily, everyone that joined live today. We'll be back fighting fit on Thursday. We do have a bunch of guest episodes, author month, a bunch of different topics. We're going to still be building our portfolio together over the next year on the Rask Invest live show. We'll be here every Thursday, or just about every Thursday, minus Thursdays that involve really bad batches of laryngitis. But we'll be back on Thursday. Voices on the mend. I couldn't talk last week at all, so we're getting there. Thanks, Viggies. Thank you, everyone that joined us live. Don't forget to head over to the Rask community and subscribe if you haven't already. And I will see you on the other side. I'll see you on Thursday as we talk about ETFs and all the wonders that come with using them to build a portfolio for retirement, for passive income, and for long-term growth. Bye for now.